Right now, in the high-stakes world of commercial real estate, the person writing the biggest check is actually often the weakest person in the boardroom. I mean, the era of the Gordon Gekko fist-slamming tycoon who just buys their way to the top, that's completely dead.
It is a massive structural shift. We are moving from an industry that used to be defined by raw financial force to one that is, frankly, entirely dependent on trust, verifiable data, and a really deep understanding of human psychology.
And that is exactly what we are unpacking in today's deep dive. We're looking at a newsletter called Pri's Perspective, which is penned by Priyanshu, or Pri Adathakkar.
Right, and we should note he is a highly specialized commercial real estate and hotel investment advisor, as well as a licensed realtor.
Exactly. And the core mission of his thesis here is to explain why capital is no longer the ultimate leverage. The most successful operators out there today are getting these highly complex multi-million-dollar deals across the finish line by relying on what he calls influence without authority.
It's a critical concept.
It really is. Because whether you are trying to raise capital, secure an off-market asset, or honestly just trying to navigate complex office politics in your own career, understanding how to get things done when no one actually owes you anything is, well, it's essentially a superpower. And by the end of our analysis today, you will have the exact blueprint for how the top tier of deal makers structure this influence to protect and compound investor capital.
So let's break down the core mechanics and technical hurdles of this asset landscape, because this shift didn't just happen out of sudden goodwill, you know? It was born out of pure economic necessity.
Right, the macro weather changed.
Exactly. If you look back just a few years, we were in a zero interest rate environment, capital was incredibly cheap, and when money is practically free, you can afford to be a bully. You can paper over a lot of operational friction and broken relationships because the profit margins are just so wide they absorb your mistakes.
But then high interest rates arrived, and underwriting standards, the strict criteria that banks use to decide if a project is actually viable, those tightened up dramatically.
And that fundamentally decentralized power across the board. For a long time, the sponsor, the person putting the deal together and taking on the operational risk, they were the undisputed king of the hill if they had the backing. Today, that power has completely scattered.
So who actually holds the keys right now? Where did that decentralized power go?
Well, first you have the lenders and the LPs. An LP is a limited partner. These are the institutions or the high net worth individuals actually supplying the equity, the raw cash.
Right.
Because borrowing money is so expensive now, they are terrified of downside risk. They demand extreme transparency before parting with a single dollar.
So the money itself is far more anxious. That makes sense. Who is the second group?
The local municipalities, so city planners, zoning boards, city councils, they hold the ultimate discretionary power over entitlements, which is essentially the legal permission to build or redevelop a site.
And they don't care about the developer's returns.
Not at all. A sponsor might want to build a dense 300-unit apartment complex to maximize their yield, but the city doesn't care about the sponsor's spreadsheet. They care about community benefit, traffic patterns, local infrastructure.
Yeah, and if they don't like a project, they will just stall it in committee until the sponsor goes bankrupt, paying interest on the empty land.
Exactly right. And then there's the third group, which is the sellers and the brokers. In a volatile market where deals are falling apart left and right, they don't necessarily care about who submits the absolute highest bid. They care about certainty. They want to know the buyer can actually close.
Okay, I hear you outlining all of this. The power is spread out among nervous LPs, stubborn city planners, and skeptical brokers. But I have to push back on this premise just a bit.
Go for it.
Let's say I'm the sponsor on a $50 million plaza acquisition. I've locked up the debt, I hold the majority equity stake, and I have the property under a legally binding contract. Doesn't that hard leverage guarantee my performance? I mean, I have the cash. I own the contract. If I decide to strong-arm the seller at the last minute to save myself a couple $1,000,000, why should I care if they're mad at me? I win.
Well, you win today. But commercial real estate is a remarkably small, highly interconnected ecosystem. The argument you're making is what Pri calls the other side, the temptation to use contractual control as a weapon.
Which is tempting, I admit.
Very tempting. And legally, you might have the upper hand. You might successfully squeeze that seller and pocket an extra $2 million.
Which sounds like a pretty good Tuesday for my fund.
Until Wednesday rolls around and you need to do another deal. If you weaponize your leverage, you trigger massive financial consequences down the line. Brokers talk to other brokers. Lenders talk to other lenders.
So the reputation catches up with you.
Instantly. If you get a reputation as a sponsor who forces compliance through hard leverage, brokers will permanently blacklist you from off-market opportunities. Lenders will put your future applications at the bottom of the pile, meaning your deal cycles will stretch out for months, which just bleeds you dry in administrative and legal costs.
So you might win that specific battle for $2 million, but
Yeah.
you completely alienate the network you need to source your next $50 million in business.
Precisely. The operators actually closing deals right now aren't using force. They are using influence. And Pri breaks this down into a highly specific blueprint. It starts with how you approach the people funding the deal.
The LPs.
Yes. The old Gordon Gekko playbook was to walk into an LP pitch, slam a spreadsheet on the mahogany table, and point to a massive headline, IRR.
And just to make sure we're all on the same page, IRR is the internal rate of return. It's essentially the annualized percentage of profit an investor can expect to make on their money, factoring in the time value of that money.
Right. Everyone loves a high IRR in a vacuum. But in today's high interest rate environment, if you walk into a room promising a 25% IRR, you aren't signaling confidence. You are signaling extreme, borderline reckless risk.
You look like a gambler.
Exactly. Pri explains that to wield true influence, sponsors have to stop talking about their own aggressive profit goals and start solving the LP's specific mandates.
Which requires an incredible amount of empathy and research before you even step into the room. You have to know what is keeping that specific LP awake at night.
You have to know their exact financial pain points. For instance, an institutional LP might be panicked about debt yield coverage. Debt yield is a simple metric. It's the property's net operating income divided by the total loan amount. It tells the bank, even if the market softens, this building generates enough cash to easily pay the mortgage.
Right.
So if an LP is worried about debt yield, you don't pitch them a risky development project with a high IRR. You pitch them a stabilized asset with reliable long-term tenants. You align with their immediate necessity.
You don't sell, you solve. That's a critical distinction. But eventually, you have to actually build the building. And that brings us to the local government. This is honestly where Pri's insights get incredibly fascinating, specifically regarding the psychology of public town hall meetings.
Yes, this is Pri's boots-on-the-ground approach in action. It's his concept of pre-wiring entitlements.
Because the standard procedure for a developer is to submit a plan, wait 3 months for an official city council meeting, and then stand at a podium in a gymnasium while angry residents just scream at them about traffic congestion and shadows blocking their gardens.
It is completely adversarial by design. It's a spectator sport.
Exactly.
And what happens when you put human beings in a public forum? Their egos take over. A city council member or a neighborhood leader feels compelled to perform for their peers. If they take a rigid stance against a project in public, they can't back down later without looking weak.
So Pri says the agile operators bypass that entirely. They don't wait for the public hearing. They pre-wire the room. They go to the city planners, the local business owners, and the loudest neighborhood advocates, and they meet with them one-on-one, privately, months before the official hearing.
The psychological mechanism there is incredibly powerful. By sitting down privately, you remove the audience. You remove the need for that community leader to posture. You ask them directly, what are your concerns about density? What are your anxieties about parking?
You listen?
You listen, and more importantly, you incorporate their feedback into the architectural design before the plans are even finalized.
So by the time you actually stand at that podium in the gymnasium, there is no bomb to defuse. You've already diffused it. The community leaders aren't fighting you. They're defending the project because they feel like they co-created it.
Exactly. You didn't use a high-priced lawyer to force a zoning change. You used early, respectful influence to make them actively want your project in their neighborhood.
But trust and good relationships will only get you so far. At a certain point, the math actually has to work. Which brings us to the necessity of leading with what Pri calls high-authority data.
Because no matter how much a city planner or a lender likes you personally, a commercial real estate deal is essentially a giant mountain of assumptions. You have to guess how much rent is going to grow next year or what the cap rate will be.
Let's unpack those terms quickly because they are the battleground of any deal. The cap rate, or capitalization rate, is basically the yield a property would generate in a year if you bought it in all cash.
Right.
So if a building costs $1 million and generates $100,000 in profit, that's a 10% cap rate. The other big assumption is absorption, which is really just a fancy way of asking how many months will it take us to actually find paying tenants for all these empty offices.
Exactly. Now, if a sponsor walks into a meeting and says, my gut tells me we can fill this building in 3 months and rents are going up 10%, they're asking the lender to trust their ego. They are trying to use personal authority.
And if the lender disagrees, suddenly it's an ego battle. It's my opinion against yours.
And in a high-stakes environment, ego battles kill deals. As Pri points out in this week's perspective, leading operators strip the subjectivity out of the room entirely. They anchor every single financial assumption in third-party verified data.
They bring in independent reports.
Right, from firms like CoStar, they bring in verified comparable sales comps from the immediate 3-block radius. This is how Pri saw what the spreadsheets missed in his own practice by relying on verified local data rather than broad assumptions.
The psychology of that is just so sharp, because if I'm the sponsor and I put independent data on the table, I'm redirecting the lender's scrutiny. I'm not saying, trust me. I'm saying, look at this independent methodology.
It changes the entire physical posture of the meeting.
It really does. We are no longer sitting face-to-face arguing with each other. We are sitting side by side analyzing the data provider together. It shifts the entire dynamic from me versus you to us versus the map.
It neutralizes opposition by removing the target. You just can't argue with a verified data set the way you can argue with a confident developer.
Moving on to our next major pillar. How this exposure is entirely neutralized when acquiring the asset itself. Because none of this matters if we don't actually have a great asset to buy. In commercial real estate, the absolute best assets are off-market. They are never listed publicly on a website for everyone to bid on.
Off-market deals are the holy grail because when an asset goes to the open market, it triggers a bidding war. Emotion takes over and buyers start driving the price up to irrational levels just to win. An off-market deal allows you to negotiate fairly and quietly.
But brokers guard those opportunities fiercely. They only bring them to a tiny inner circle of buyers. So how do these agile sponsors actually get inside that circle? How do they build that broker reciprocity?
It has nothing to do with buying them expensive dinners or, taking them golfing. It is entirely based on operational certainty. Pri outlines 2 non-negotiable rules here. First, you close on time, every single time. Second, and most importantly, you never retrade without a deeply material cause.
We need to define the retrade, because it is the ultimate villain move in real estate.
It really is. A retrade happens when a buyer gets a property under contract at a specific price, let's say $20 million. The seller takes the property off the market and starts planning their next move. Then, just days before the official closing date, the buyer suddenly threatens to walk away from the deal entirely unless the seller drops the price to $18 million.
They hold the deal hostage. Now, to be fair, if the buyer found out during the inspection that the foundation is cracked and the roof is caving in, that's a material cause that justifies renegotiating.
Right, that's valid.
But a bad faith retrade is just a pure leverage play. The buyer knows the seller is desperate for the cash and doesn't want to start the whole sales process over again. So they squeeze them.
It is the ultimate expression of the Gordon Gekko hard leverage mindset. And Pri's point is that if you execute a bad faith retrade, you have completely destroyed your reputation with that broker. A broker's entire livelihood depends on deals actually closing.
Yeah, you introduce total chaos into their pipeline.
Exactly. They will never bring you a quiet, off-market deal again.
But on the flip side, if you have a rock-solid reputation for never retrading and you actually share your own proprietary market intel with those brokers to help them win other listings, you become an asset to them.
You are trading a temporary, sleazy discount today for a lifetime of first-look access to the best properties in the city. You become their first phone call because you represent absolute certainty in an uncertain world.
Which perfectly sets up the final piece of this blueprint, which is how to actually ask the LPs to wire the money. Because asking an LP for $50 million to develop a dirt lot is like walking up to a stranger on a first date and proposing marriage.
They are going to run away. It's too big of a leap of faith.
Right. You have to ask them to go steady first. So how are these sophisticated operators de-risking that process?
They use phased commitments. Instead of asking for all the money up front, they structure the capital calls, which are the moments when they actually require the investors to send funds around highly specific pre-development milestones.
Give me an example of how that works in practice.
Well, let's say you want to build a major retail center. Instead of asking for the full construction budget, you ask the LPs for just enough seed capital to complete the initial architectural designs and do some preliminary site work.
Okay, a smaller ask.
Right. Then you take those designs and use your influence to secure a letter of intent, an LOI from a massive anchor tenant like a national grocery chain.
And an LOI is basically a formal written document where the grocer says, if you build this, we promise to sign a 10-year lease.
Exactly. And once you have that signed LOI in your hand, the risk profile of the entire project drops to almost zero. You have mathematically proven that there is massive demand for this building before you've even poured the concrete. And only then do you go back to the LPs.
Yes.
Right.
You go back and say, okay, we have the anchor tenant locked in. Now we need the rest of the equity to start construction.
You aren't using authority to demand a blind leap of faith. You are creating a logical, step-by-step pathway where saying yes to wiring the millions is just the most obvious, low-risk decision they can make.
It's risk mitigation as a form of absolute influence.
So if we zoom out from these granular day-to-day mechanics, Pri also identifies a few major macroeconomic horizons to watch as the year closes out.
He focuses on 3 key trends. The first goes right back to the municipalities. Watch which cities are actively streamlining their administrative approvals versus the cities that are piling on more bureaucratic friction.
Because capital operates like water, right? It flows to the path of least resistance.
Exactly. The cities that streamline are going to see massive development, while the ones relying on red tape will just stagnate. The second trend he flags is LP sentiment shifts, which really means closely monitoring how the big institutional funds are adjusting their risk tolerance. Because if you are a sponsor and you don't realize that your LPs have suddenly shifted their focus from aggressive growth to conservative debt yield coverage, you're going to waste months pitching the wrong projects.
And the final trend is a massive flight to quality. Because the market is still so unpredictable, top brokers and sellers are increasingly routing their absolute best off-market assets exclusively to sponsors with flawless execution records. The gap between the highly influential operators and everyone else is widening rapidly.
And that leads to the core philosophy that underpins everything Pri wrote here. He notes that after years of advising on incredibly complex repositioning projects, he realized that the most successful transactions were never forced by decree. They were never the result of someone pounding their fist on the table and demanding compliance.
No, they were built by listening first, understanding the implicit financial anxieties of everyone in the room, and structuring a win for all parties.
It's a profound realization. When you do the heavy, unglamorous lifting of building a flawless track record, when you consistently deliver verifiable data and operational certainty, formal authority becomes entirely redundant. Your reputation enters the room before you do, and it does all the negotiating for you.
It really is the difference between demanding respect because you have a title and commanding respect because you have a track record. In commercial real estate, and frankly, in any complex organizational structure on Earth, authority is just the ink printed on your business card.
Influence is the actual, tangible currency that gets deals funded, zoning approved, and assets acquired.
It requires recognizing that the leverage doesn't sit in the bank account anymore. It sits in the relationships, the third-party data, and the ability to systematically de-risk a situation for everyone involved.
Which leaves us with a highly provocative thought to explore on our own. We are seeing this demand for transparency and decentralized power sweep across almost every major industry right now, not just real estate. So as the market places a premium on agility, trust, and verified data, will the legacy mega institutions, the massive firms that still rely entirely on the brute force hard leverage of their historical brand names and deep pockets, will they find themselves entirely priced out of the best opportunities? It's a very real possibility. Could we see a future where the biggest players in the world are routinely outmaneuvered by smaller, hyperagile operators who have simply mastered the art of influence without authority?
If you are still relying solely on the weight of your capital in a market that explicitly values certainty and trust above all else, you are playing a game that ended a decade ago.
The days of flashing a giant checkbook to dictate the rules are fading fast. The most powerful person in the room isn't the one yelling the loudest. It's the one who quietly aligned everyone's incentives before the meeting even started. Thank you for joining us on this deep dive.
You've got the perspective. Now it's time to drive the news forward. To ensure you never miss a market shift, tap subscribe on Spotify, Apple Podcasts, or wherever you listen. If today's insights are going to impact your strategy, share this episode with a colleague or investment partner who needs to see the big picture. For actionable guides, newsletter subscriptions, and direct advisor consultation, head over to bearinvestors.com. Thank you for listening. We'll watch the market closely until next week.